Hey guys, Jonathan Mills Patrick with you today. Thank you so much for joining me. Today I want to talk to you about the difference between raising a round of funding or financing your business venture, the difference between doing that through debt or equity. Now, the key to understanding the two of these is how they work and how the people that are providing that type of financing, how they look at things differently. So first, we're going to talk about the difference between a historical perspective and a futuristic perspective. Now, when you're looking to raise funding through debt, lenders are providing you capital and they are doing that based on what you say you have done in the past. That's what I mean by historical perspective. That's why when you try and borrow money for a business, lenders are asking for a lot of documentation. It includes all kinds of things. Most importantly, they'll be asking you for numerous years of your tax returns for your business and any other business in which you own a fair amount of equity. The reason is they're looking at the historical performance of that business or businesses to understand how they've done and then to use those numbers to anticipate what type of cash flow or performance they can expect from you in the future. But they are looking backwards first in order to do that. So that's what I mean by a historical perspective. And lenders, people who are providing debt, are unique in that from a funding perspective in that they are looking at a historical performance. Now, investors are looking at futuristic performance. There are some ways for investors to take a look at what you're doing to understand the type of performance they can anticipate in the future. But the vast majority of investing in a business is based on what the startup founders say they're going to do. That's why you have to have pitch decks involved to talk about the market size and market opportunity, the solution you have, and all of those things add to an investor's ability to understand your future performance. There's no tax returns to look at in most startups. If your startup's been around for less than a year or even 2 years, there's not much of that historical record to look at that a lender would look at. There may not even be really good profit and loss statements for an investor to look at in order to get a historical perspective. So investors are very futuristic focused and lenders are very historical focused. One more note on this before we move on. When I talk about investors, I'm talking about friends and family rounds. I'm talking about angel investors. I'm talking about venture capitalists. All the way through that continuum of funding is a futuristic perspective for the most part. And then you get toward lenders and you're really looking at a historical perspective. Now, are there types of funding that get into sort of a hybrid of these two? There are. One example is what's called a convertible debt, convertible note. I'll talk about that in a future video for you. But for now, understand before you're raising funding, are the people that you're speaking to historically minded or futuristic minded? The difference is whether they provide debt and or equity in that vehicle. So historical versus futuristic performance. The thing about debt to understand is that with debt, you're exchanging interest that you will pay that lender in exchange for capital that they're going to provide you. So you're not only paying back what's called the principal amount. So if you borrow $100,000, the lender expects you to pay them back $100,000 plus whatever the interest rate is that they peg you at and you accept per annum every single year. So with debt, you're exchanging getting that type of funding in exchange for paying extra money back to the lender. There are some benefits to debt. You get to retain control of your business. You're not giving up any shares in your business. You're not having to have a lender. Typically is not going to tell you how to run your business. They generally just want to provide you that capital, have you go away and operate your business model, and as long as you're paying them their payments, and which includes their interest, they're pretty happy to leave you alone and let you go about things. Of course, if you choose to not pay that back, they're going to take some actions like foreclosing on you or collecting any assets that they may have liens on. So if with debt, just understand that you're exchanging it for interest, but you get to retain control. Now, there's another piece to debt that a lot of startup founders don't seem to grasp and are very hesitant with. I definitely get it, and that is personal guarantees. I was a commercial lender for most of my banking career before I moved into the C-suite, and I did over $500 million in transactions between debt and equity. And during that time, I only saw one loan that was done without the personal guarantee of the owners. Now, that particular loan was done that way because the company was so large and there were so many owners that the bank just didn't want to have to deal with that many personal guarantees. But in most instances with a small business, you have one owner, maybe a couple of owners, and the bank will almost always ask for a personal guarantee. What does that mean for you as the business owner if you have signed on to borrow money from someone? It means that if the business is not able to pay back that debt plus that interest or any other fees, that the lender, for example, a bank, can come after any of the business owners, any individual business owner, to force them to pay that back. So if you go the debt route, you will 99% of the time be forced to sign a personal guarantee. It's something you need to take into account. Now, this is easy for me to say as someone who's been in that profession, but the way I see it, a personal guarantee is just table stakes for taking out a loan, meaning it's just common. And if you're not willing to put your own assets or financial future at risk, why should the bank or some other lender give you a loan in the first place? If you're not willing to take some risk, why should they? So that's the route going for debt. Now, with equity, you're exchanging the funding you're going to receive in exchange for typically ownership in your business. Now, again, I alluded to earlier that there are other financing vehicles that are sort of hybrid between these two, but we're going to stay away from those for now. Just going to focus on the basics. With equity, you exchange your ownership stake for money. In many instances, with a seed round being the very first round that you raise, what we typically see is X dollars, so maybe $100,000 in funding, maybe $250,000 in funding, in exchange for right about between 15 and 30% ownership. That means the owner or owners still retain up to 70% ownership in the business, but they have given up a chunk. The reason that's important is with debt, you're paying interest, which is that fixed interest amount every single year until the loan is paid back. With equity, giving up shares in your company to someone, they are taking advantage of the growth opportunity with your company. But that also means that they're taking more risk. So could you theoretically be giving away much more money to an investor than if you were to borrow money? Theoretically you could, but the investor typically is taking more risk. So with equity, exchange ownership for dollars that they give you. This is more common with a startup. I want to stop here and make it clear to you that there is the possibility of getting loans for startups. I've been involved in the industry for a long time on both sides with both debt and equity, and what we call venture debt does exist. It's just harder to get and it's much less common because lenders, go back to what we talked about earlier, lenders are looking at that historical perspective, and there's typically isn't a historical perspective with startups, so most lenders are adverse or will not lend to startups. However, there are programs out there, and I talk about some of them in my Sources of Capital ebook and course that I'll try and link to for you. So equity, exchanging dollars for ownership in your business, is much more common, and it's what we are all seeing on these shows like Shark Tank and things like that. Now, with equity, what you're doing when you exchange dollars for that ownership is you're giving someone else ownership in your business, which means they have the right to tell you, or at least suggest ways that you should operate your business. That's part of it. Typically, when investors put money into a business, they may ask you to form an official board and ask for a seat or seats on that board. So perhaps you will be told to form a 5-person board, and maybe depending on the amount of money they've given you in exchange for ownership, that investor or investors may ask for 2 out of 5 seats on the board. So you're exchanging dollars for ownership, which gives them the right to tell you or suggest ways in which you should operate, and it also gives them the right to have some level of control through a board and other things like that. On the flip side, with debt, we talked about personal guarantees. Remember or know that with equity, a personal guarantee can happen but in most instances, it does not happen. I have seen it on different term sheets, which is when the investor provides you their offer in writing, but personal guarantees through equity is less common than debt. So the thing to take away today is that you need to understand the difference between these two funding vehicles, debt and equity, because you need to stop and think about what your personal preferences are and how those funding mechanisms fit into your business model. Now, a couple more things before we finish up. Another thing to understand about debt is typically to get debt, you have to have some level of revenue. You have to have money coming in, and in fact, you often have to have net revenue, which means money left over after you pay all your expenses and your costs of goods sold. The reason is lenders use that number to prove that you have the ability to pay them back. So with debt, oftentimes you have to have some existing revenue. Does that mean if you're a startup and do not have existing revenue, you cannot get a loan? It does not. Here's why. Sometimes the right lenders who are willing to lend to startups will look at what's called a global view, and they will look at all income sources and all expenses to determine if they're willing to give you a loan. And what I mean by that is even if your new business does not have income or revenue coming in, maybe the founders do through other sources like day jobs, like other businesses. So it is possible for a startup to get a loan. If it has no revenue, it's just not as common. The other thing about debt to understand is it is often much quicker to be able to get access to. Now, some loan processes these days still take quite a bit longer than I think they should, but it's still quicker than equity. With equity, you're going through a lot more due diligence, a lot more meetings. You're talking to a lot more investors to even try and land an investor in the first place. So debt can be much quicker. One last thing with equity is often, at least with startups, in my experience, what I have seen is that with equity, startups are able to raise more money than they would through debt. Now, one more thing to understand on the equity side before we're finished up today is that getting equity financing through investors is about more than money. I've talked about this before, so I hope the point is hitting home with you. When you're raising money through investors, them writing you a check is absolutely wonderful, but the things that they bring to the table can go a lot further. For instance, the right investor can bring experience in your industry. They can bring knowledge in your industry. They can bring contacts in your industry or other industries that you need them in. For instance, if you need suppliers and don't have experience with those, the right investor can lead you to them. They can also lead you to other investors. So going the equity route versus debt has yet another benefit. Again, remember I mentioned that with debt, as long as you're making your payments, they typically stay out of your business. That can be a good thing. But if you need more than just the funding and need some additional input and experience behind what you're doing, equity can be the right route to go because that investor now has ownership in your business and is going to care more about your success beyond just making money back. So, hope all these things help for you. The bottom line is before you go raise funding for your startup, make sure you understand the difference between when debt works well and when equity works well, how they work in general, and that will also help you be more specific with who you target for your financing round. Hope that helps a lot. Thanks a lot. Appreciate your time. Have a great day.